Hello, Bhaskar, and welcome to the show. Let me start by asking you, the way markets have reacted to the new COVID strain, it seems that they know more than the medical experts do right now. So what's your take on this?
That's a very nice way of putting it, Puneet. But let's put it this way, and I think that's at least from a market sense and from the way that we look at the investment world, I think we're very clear that the risk from COVID is not going away. Now, I don't want to specifically comment on one variant versus the other, but I think the way to look at it is when you're building in any scenario from a portfolio construction point of view, from a risk budget point of view, I think you have to take into account that COVID in one form or the other is going to keep bouncing back like a bad penny in the construct.
Okay. How do you see 2022 shaping up for equities then as an asset class?
I mean, I think that this decade, the coming decade, belongs to equities. There is, I think, very little doubt on this. Okay. So across the world, I think equities will end up being the winners of the 2020s as against any other, as against at least the fixed income universe. I'm not saying that there's no opportunity in the fixed income universe, but I think as a broad asset class, I would choose equities over fixed income. Now, in that space, there are a couple of large, still aggressive growers, I would say, or new growers, and these happen to stem from a few places. And they traditionally, or at least in the last few years, have been US, China, India, are the main hotspots, okay? Where either you're getting new companies or the growth is just structurally stronger than other places. And I think that's why India is a long-term story, I think still has a lot of legs. Now, we can talk about valuations in India. They're always going to look aggressive and rich. They've always looked aggressive and rich. So as we always say, valuations is a resultant. That's not what you make all your decisions on. But I think India Inc., in that sense, still has legs from any long-term kind of potential that you can think of. But I would still be voting. If you want to ask me from a global investor's point of view, the big bet still is the US. It's the developed markets. It's the US leading that way.
So how does the FI picture look? How are they viewing India as an investment destination within the Asian and the emerging market universe?
Well, first, let me start with the global so that you get the global picture.
Sure.
India is still the marginal allocation. It's not, it doesn't take center stage for multiple reasons. There are access issues, and you also have it as still as a small, from a weighting point of view. Even today, even in MSCI Asia Japan, it's about 13% now of the index weight. So it's not dramatic when you look at it from a world complex, right? Because you still have whatever 51, 52% of the world market being in the US. So I think that's why the predominant bet has always been China as the larger market. But given what we've seen there, maybe that's one opportunity set. But given the flows again this year, that doesn't seem to have happened, right? It's not like people sold out of China and bought India. For me, really, what really sinks to me in India is the SIP. The fact that the locals are participating in this for the first time, I think, in a long time, systematically in the bull run.
So what's your sense on corporate earnings for the next few quarters in the Indian context?
Okay. Well, I think one is the Indian context, but I'll also give you the global context on this. Because, we're going to have 2021 to be a big base year effect when it comes to 22. So almost nothing is going to look as exciting as it did in 2021. Okay. This year, by the way, will go down in history as the biggest beat year across the world. I mean, it doesn't matter where you are, right? And I think this will almost never be repeated for a very, very long period of time. So we have to take that into account. In a way, we always say that the market's smarter than all of us. So I'm assuming the market knows this. If we know it, the market knows it. So I'm assuming that's where it will be. But I don't think it'll be a negative earnings growth, if that's what you're asking.
Okay. So in this backdrop, what should be the ideal portfolio construct for investors to tackle opportunities and risks that lie ahead in 2022?
Look, I think for the middle of the line investor, I think somewhere between 52 to 55 is where you need to be on equities. You are somewhere between somewhere around 35 in bonds, maybe about 10 or so in alternate assets, and a little bit of cash is typically where you should be. at this point in time, so give or take a few percentage points here or there. So again, like I said, the bet is really for the average risk profile. I think the equity space is the best place to be. And I think this applies everywhere, including India. So
thanks, Bhaskar, for joining us today. We hope to see you soon again.
Thank you. Thanks, Ray.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.